Hello, my name is Trey, and welcome to the Q3 2024 review. I want to start with what I would like you to take away from this. So I wanted to go over a key planning principle, and that's in relation to RSPs. See, RSPs do two main things. First of all, they move income from one year into another. And hopefully you use this feature when you're in a higher income tax bracket. Maybe during your working years, you put money in, and then when you're in a lower income tax bracket, you take it out, ideally in your retirement years. And second of all, they allow the portfolio within the RSP to grow tax deferred. What that means is that money stays in the portfolio and continues to grow over time instead of in a different type of account, you having to pay taxes as you go. Where's the pitfall in this? Well, the pitfall can be if you get to a point in your retirement where you have no other assets to rely on apart from money that is in RSPs. This becomes an issue when you need big purchases. Think, for example, if you was taking $60,000 out of your RSPs to fund your lifestyle, that's $60,000 of taxable income. And now let's say you need a vehicle, and that vehicle is going to cost, let's say, $60,000. Well, that means now that you need to take almost $93,000 extra out of your RSPs to fund that $60,000 that you need. On that $93,000 withdrawal, you're paying almost 40% tax on that amount when you could have avoided that. Why? Well, because you didn't leave yourself options. And the only place you had access to money was from your RSPs. So don't fall into that trap of only putting retirement savings inside of RSPs. Diversify. That's what TFSAs and things like that are for. Now let's look at the current environment that we're in. First off, the economy seems to be slowing, and that indicates that we will likely see rate cuts into the future. When we look at the past year or so in the markets have been very strong. Look, here we see the Canadian market, the US market, across the board, the markets are up, and that is obviously a good thing. But keep in mind that the expectation is that they go up. If we look at just the last quarter, we see the markets are still up, but we do also see an expected positive. So the average quarterly returns here are all positive. The majority of the time, the markets are going to be going up. But keep in mind that the markets do go down still. And while, yes, the last few years may have created a sense of euphoria in the markets that they can't possibly go down, it is important to, not too long ago, we did see large downs in the markets. When we look at some of the worst quarters, this was 2022 was one of the worst quarters for the US market, and it was down 14% in a single quarter. And then previous to that, we had 2008. So it's important, while it's been a good few years, not to get ahead of ourselves and pile on the risk if we don't have the appetite for it, because the market returns have been so strong. And to remember that this does come with downs. On the fixed income side, because we are seeing or expect to see interest rates come down, that will impact GICs and bonds. And that's the low risk part of a portfolio. That means going forwards, yes, we may have enjoyed 4.5%, 5% yields on bonds and GICs. That is unlikely to continue. So if the expectation is to be getting 5% in a very low risk portfolio, that is not something that has been sustainable or ever was sustainable. So maybe it's time to adjust the expectations. Those are the key points. If you do have any concerns, as always, please feel free to reach out to me, and I'll see you in the next one.